This is Money Stories.
Brought to you by Amy and Ben from In Financial Services.
Today we're joined by Janine, Amy and Ben for another Money Questions episode. Today we'll discuss what the Labor government win means for you and what it means for first home buyers and investors.
Welcome back to another episode of Money Stories, but this is a bonus episode, Money Questions. And today we're discussing the big L word that's been trending this week, and it's not Labubu. It's the Labor government got elected. So we wanted to talk about what does Labor's 2025 win mean for first home buyers, investors and HECS debt holders?
Yeah, all big topics.
I thought Labubu was quite big. Now you're telling me it's not.
They're both big. Forgot to mention we're here with Janine and Ben.
Hello.
Okay, so what does Labor's government re-elected for another 3 years mean to first home buyers and investors? And what does it mean for the property market? I know that they've promised a lot of things in that space.
I suppose we probably should speak about the policies that they've brought in and then what each individual one, how it will affect the market and how it will affect the people that are trying to get into the market.
Yeah, there's definitely a lot to unpack. So
There
that question's very open-ended. But yeah, basically to make it as simple as possible, it should mean that a lot of first home buyers are going to have access to getting into the market, which is good.
Okay, well, we'll break down a few of the key housing policies that they announced. One of the first ones was the Help to Buy scheme, the Shared Equity Program.
Yeah.
So they've said that eligible buyers can purchase a home with little as a 2% deposit, and the government contributes up to 40% for new builds and 30% for existing homes.
Yep.
And the buyers can gradually buy out the government share over time.
Yeah, so I think this will be a pretty big one for first home buyers who they've got to meet their income caps. So I believe the income caps are 100,000 for singles, and
160, I think.
160 for couples.
Yeah.
So if you don't earn over that amount, then basically what they're saying here is the government will help by buying a portion of your new home. So I believe that's 40% for new homes,
Up to
40% for new homes, or up to 30% for existing homes, which essentially means you can get into the market owning 60, 70% of a home.
Yeah.
And then they'll help buy the rest. You'll only have a loan against your portion of the home. Essentially getting into the market at a cheaper rate. Although you don't own the whole home, you are still benefiting from the growth of property and getting into the market earlier.
And is it any different to what was already on offer in that area?
Yeah, well, it is a little bit different, but you're right. There was already something that was on offer, and I think that was called the
like shared equity or something.
Yeah,
shared equity scheme. Same scheme.
They tested it out. It wasn't on offer everywhere.
Yeah,
they did test it out, and the income caps were a bit lower as well. So, and
it was only for selected employment types.
Yeah. So it wasn't available to all first home buyers, but they were still testing it out.
Yeah,
I don't know if this one's going to be as big as what you might think, because the previous one, I don't really think that was amazing. I don't think it's going to change a huge amount, this one.
Yeah, I don't think it's going to be their biggest policy. We'll get into the next one soon. But I still do think that any singles that are earning under that 100K mark, they're going to have a bigger opportunity to get into the property market, especially on today's rates. And
okay. So it's just lowering the barriers.
That's right. Yeah. And if you're single and you're like, well, hey, I can't get in. We've had clients that have bought in with family members, like two sisters or two brothers might buy together. Now you don't have to.
Yeah.
Now you can get there and you can buy it yourself, but obviously with the government. And so at least that you're getting into the market. So if you aren't in that position to be able to do it by yourself, it is a great scheme to be able to then, be in the market.
So, but what do you think about buying with the government? Kind of sounds interesting.
Yeah.
I don't see any problem with it.
I don't see any problem with it. It's more about getting your foot in the door. So just to break it down like as simple as possible.
Yeah.
Say you're buying a new home worth $1 million and the government bought up to their max portion of that. So they bought 40% of that. They would put in $400,000 and you'd only be buying $600,000 worth of that property and getting your loan against that. So you're getting $1 million property for $600,000. Now, obviously, you are only getting 60% of that.
Yeah.
But as that grows, say that grows to the maths is going to be hard here, but say that goes to 1.1 million, then you've just earned $60,000 in equity. Obviously, the government earns their $40,000 in equity, so you still have to pay out their portion when you sell that property. But you're just getting into the market sooner and capitalising on that growth sooner.
Yeah. Okay. So not
At
too bad.
least you know they're good for the money. If you're with somebody else and you go and you buy a property, like say 50-50, well, you're then also responsible for their loan, they're responsible for your loan. So
and you're sort of trusting that they're going to do right by their repayments.
Yeah. And if they don't do right by their repayments, well, then your property is on the line. Yeah. Whereas the governments, they'll be right with that.
Good.
Yeah.
So the next one they've announced, and I think this is the one that you were most excited for, is the expansion of the home guarantee scheme. So it allows first home buyers to purchase with a 5% deposit without paying LMI, so lender's mortgage insurance. And it said that the median home price in Australia today is $820,000. So 5% of that's like $41,000. And the last time $41,000 covered 20% deposit for a median home was 2002. So that's the change in the amount that people need to save now.
So we have had a home guarantee scheme, but it's been capped in relation to the property prices that you can buy up to and also the income levels that you can buy up to.
Okay.
So the main difference now is that they're taking the income caps away. There's still going to be property price caps, but those property price caps have increased dramatically in your capital cities. So the Newcastle property prices will be able to go up to 1.5 million, but your regional is 800,000. So your Maitlands and your areas, anything from like basically Thornton up, will have a property price cap of 800,000, which I'm going to say isn't like a huge amount for that location. I feel
Isn't it similar to what they already had?
Well, it's 750 at the moment.
Yeah, they had 750 at the moment, and they're increasing it to 800,000. Whereas if you look at Newcastle, they currently have 900,000, increasing to 1.5 million.
Oh, wow.
So that's a huge jump. Whereas like Maitland and other New South Wales regional areas are only getting that 50,000 jump.
Yeah.
So I feel like first home buyers now are actually going to have to be mindful of the suburbs that they're buying in and actually really look at the postcodes before they start deciding where do I want to be living, because getting there and having mortgage insurance or not having mortgage insurance, it makes a big difference to a loan.
Yeah.
And there is a great tool that makes that very easy. So this scheme is offered by Housing Australia, which is a part of the government, and they have a tool on their website which is a property price cap tool. And you just punch in the postcode and the suburb you're looking to buy in, and it'll tell you exactly what that price cap is in that suburb.
And they're saying that you can get in with a 5% deposit, which is right. But if we're just talking New South Wales, we're still anything you're still going to have to pay some stamp duty depending on the property value that you're buying. So it's not like that it's just 5% that you're going to have. You're still going to have your 5% and then plus also some money for your stamp duty.
Yeah, just on that, the current stamp duty caps in New South Wales are at that 800,000 mark. So anything below a purchase price of 800,000, you pay $0 in stamp duty. And then from 800,000 to $1 million, it's a concessional rate. So
okay. So if a person's buying in Newcastle with the 5% deposit under this scheme, they're still, if they're going over that $800,000 limit for that 1.5 cap.
Yeah, so this scheme is different to the wave stamp duty scheme. So if you buy in Newcastle, under this scheme, you've got the availability to buy up to 1.5 million with a 5% deposit. If you buy 800,000 or lower, you'll have $0 in stamp duty. If you buy 800,000 to $1 million, you'll have a concessional rate.
Yeah.
So depending on whereabouts you buy, it's like a curve. If you buy for 800,000, it's obviously 0%. If you buy for $1 million, it's 100%. Say 900,000, maybe 50% stamp duty. It like ramps up. Mm-hmm. Anything over $1 million purchase price, you're paying 100% stamp duty, which on $1 million is probably around like 45,000 in stamp duty.
So do you think we'll see more first home buyers trying to buy in capital cities because they've got that higher cap?
Yeah, they do have that higher cap, but then you've also got the stamp duty.
Yeah.
See, at the moment, that regional area cap is matched exactly to that wave stamp duty.
Yeah. Okay.
Now that wave stamp duty could change, so don't say that that's going to be the exact same. But at the moment, that regional cap of 800,000 is matched to that zero stamp duty of 800,000.
And of course, the stamp duty is state based.
Yeah. Okay.
So it's
we're talking New South Wales here. Obviously, state based.
But then again, like it's the government, like state based government, has to be the one that changes that, whereas the scheme is federal based.
Mm-hmm.
Yeah, but also those scheme limits do change from state to state as well. So
postcode to postcode.
Yeah, exactly.
So what are you excited about in this policy?
I think the most exciting thing, so this is already a policy that they've had for the last 3 years, 4 years, and they've just updated it. Mm. So I think the most exciting part about the update is, one, they've pushed those property caps a little bit, opening up just a little bit more opportunity in that area.
Yeah.
But the most exciting thing for me is they've waived the income caps on this scheme. Mm. So it used to be income caps of 125,000 for singles or 200,000 for couples, which you think is like quite a bit until you have like a single come in and they're on 126,000 and they just miss out on that scheme. And like their borrowing capacity is all good, but they've only got that 5% deposit. They don't have a 20% deposit. So then they have to go down the path of paying LMI, which for them might be $20,000, $30,000. And it's just a little bit of a rip for them because they had that $1,000 over the cap, the income cap.
And they thought they were doing the right thing because they were doing overtime because they were trying to save money and all that sort of stuff. You're like, oh, damn.
And with wages now, like 120, it used to seem like a crazy amount, but it doesn't really seem like a crazy amount anymore.
Yeah.
Especially for a single person.
And
they would just need that to live.
Yeah, like Janine said, that income cap went off their last year's tax return. So they might have had like a base income of 80, 90,000 and they might have been all good to use that scheme, but they put in like a little bit of extra overtime to get up to that 120,000 and save that 30,000 in savings. And all of a sudden they've put themselves out of possibility for using that scheme.
I think the advantage of this scheme is that it will probably stop as many people doing the family guarantee scheme because now the clients that had to go down that path because, like Ben was saying, they were capped out in relation to their incomes and they couldn't get the scheme, they now will be in the position where they can get the scheme, so they won't need to be using the parents' property as part security if they have some form of savings. Or it could be that the parents decide to act differently and say, okay, well, instead of using my property, I might gift you a non-repayable gift of X amount that can help you get into the market because that's your 5%.
Yeah, okay.
So it just might make it that you take advantage of these things in a different way.
Yeah.
Yeah. And I think the other interesting thing just around this scheme is, again, they had this scheme in place before, but it had caps on how many people could actually use the scheme.
Yeah.
So coming towards the end of a financial year, you'd have first home buyers come in and say like, hey, is there actually still any positions left under this scheme? And they could be eligible to use that scheme, but there might not have been a position available for them to use it, which again is a bit of a rip for them.
So they've removed that now.
So yeah, they've removed the caps on how many people can use this scheme now. So it's just opened up to all first home buyers basically.
That is cool.
Yeah.
Yeah.
Let's talk about the next policy they've announced, which is the construction of 100,000 new homes for first home buyers, exclusively for first home buyers.
Yeah, I think this is, again, pretty good. You're just opening up the supply for first home buyers. So 100,000 extra homes that are only available for first home buyers to purchase is just increasing that supply of houses available. Now, they might not be in the areas that
Yeah,
first
exactly.
home buyers
Yeah.
want to purchase.
Yeah.
And that's just...
And are these like affordable housing, or is it like, how are they doing that?
Well, this is the thing. You don't really know a lot of information about this one.
Yeah.
Yeah. But I have heard a lot of people say, oh, how are they building 100,000 homes for $10 billion when that's only $100,000 a house?
Yeah.
But you have to remember that people are buying these houses. So people are also putting in their money to buy the houses.
Yeah, okay.
So it's only $100,000 per house, but that doesn't mean it only costs $100,000 to build that house. Because, yeah, like I said, people are buying the houses, so people are putting in money as well.
Mm-hmm. So one to watch, but we just don't know
I
enough.
think it's a wait and watch.
Yeah.
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 It's going to really depend on where the houses are built and
Yeah.
if the first home buyers want to live there. Obviously, it's increasing the supply for them, but where they're
Well,
built.
but it's all positive, isn't it?
Yeah.
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 They've done another policy around increasing supply, which is they've promised 1.2 million new homes by 2029 to ease pressure on the housing market. So that's also another one to watch, I guess.
Yeah, it is another one to watch, and of course that's only like what they're trying to get to. It's a target.
Yeah.
Yeah,
so it
so-
doesn't mean that that's going to happen.
Yeah.
And going
and
off,
they had similar targets for
Yeah.
that over the last 3 years as well. I think
Yeah.
around that 1 to 1.2 million for new homes.
Mm-hmm.
Now they did fall short of that target over the last
Yeah.
3 years,
Yeah.
but it's mainly more about just trying to increase the supply and also trying to bring in more trades and build trades in the area.
Yeah. Let's talk about one that I am excited for. It's not a housing policy, but it is something that I guess would affect young people and investors and people that have a HECS debt. They've said that they will do a 20% reduction in student loan debts. So all existing student loan debts will be reduced by 20% starting on the 1st of June 2025. And this applies to help, vet and apprenticeship support loans.
so that is pretty exciting for
That is
anyone with a
pretty
HECS debt.
exciting. Yeah.
Yeah. Yeah.
Yeah,
Yeah.
that's definitely a massive one.
Yeah.
It doesn't change a person's borrowing capacity in relation to what can they do and how much they can afford to buy, unless it wipes out their HECS debt. Which, if you're getting rid of 20%, it's not wiping out your HECS debt.
Yeah. But I've got some amounts here. So that means like if you have a current HECS debt of 30 grand, your 20% reduction is like 6 grand. So your new balance would be 24. And if you're like me and you've got a HECS debt of 80 grand, your 20% reduction will be 16 grand. So you go down to 64.
Yeah.
So even though it's not helping your borrowing capacity, that's like 16 grand that you're saving out of your money that you've already paid tax on and earned.
Yeah.
It's a huge chunk of savings and definitely step in the right direction to getting rid of people's HECS
Yeah.
and helping them out.
They say that this reduction will be automatically applied by the ATO on the 1st of June and that borrowers don't need to take any action and it'll be processed automatically. So that's a good one
Yeah, that is a good one.
for young people.
And then, as Janine was saying, it doesn't really affect your borrowing capacity because your HECS debt repayments are based on your income. So whatever income you're earning, then the bank will use that to calculate how much you pay back to your HECS.
Yeah.
Where it does help is there are banks bringing out some friendly HECS debt policies. So like CBA is bringing out a new policy around HECS debt where if you're due to clear that HECS debt in the next year, then they will remove it as a liability. So that would help your borrowing capacity. Or if you're due to remove that HECS debt in the next 5 years, then they'll use a percentage of that HECS debt repayment. So also increasing your borrowing capacity slightly.
Yeah. Another thing that they have announced on that is that they're increasing the repayment threshold. So the threshold for student loan repayments will rise from 54,435 to 67,000. So I guess people that are going for a loan under that 67,000, they'll have more money in their pocket to go borrow more, right?
Yeah,
So-
definitely.
Yeah, that'll definitely help them because then, the HECS debts won't be calculated in their borrowing capacity.
Yeah. And it also says that an example of that is an individual earning 700,000 will pay around 1,300 less per year in repayments under the new system. So all positive stuff for the HECS debt
Yep.
with this government.
Yeah.
They did say that they haven't made any changes to negative gearing and tax, which is good for investors, but both governments were saying that they weren't changing that. So just another one to watch.
Just one more thing around their HECS debt. I believe it's just a once-off 20% reduction to current HECS debts to basically offset the indexation that was applied to those HECS debts over the last 2 years after COVID.
So indexation will still apply?
Indexation will still, like, nothing changes on the HECS debt side of things. Anyone going to uni now will still have to pay the same amount, I believe, and end up with the same HECS debt at the end and end up with that being indexed each year, as will current HECS debt holders. It'll be indexed each year. But the 20% reduction is just a one-off reduction for people who currently own a HECS debt.
Yeah. Okay, well, that's pretty much all that I've got on their policies. Do you guys have any other points to add?
No, I think the main winners really in relation to the whole housing market, and it needed to be this way too, was your first home buyers.
Yeah.
Giving more people the ability to get into the market with needing less amount of money or needing less amount of support from family members. And that's definitely a positive. The only negative that could come off the back of that is that the lower end prices of properties could increase because there now is more demand on the amount of properties that we currently have, because we do have that supply shortage, hence the reason why they're trying to build more properties. So that could be the only negative. Now, some people obviously won't see that as a negative, because if you own a property, who doesn't want their house to increase in value?
Yeah.
So, but like the fact that a first home buyer will be able to get into the market with only having that 5%, and the fact that like Newcastle and the capital city areas have got that 1.5 million that you can go up to, like that's all really good, like positive things for anyone that wants to, start off.
So what do you think key takeaway for a first home buyer would be?
Key takeaway for first home buyers is there's more options available now. So you've got a few different schemes, or you will have a few different schemes.
Yep.
There's more positions and more availability around those schemes, so less income caps on them. So now more people are eligible. So I think a key takeaway for me is just figuring out what you can do again. So if you've already had a meeting with a mortgage broker a year ago, maybe reach out again and just like get an updated view of what you can do. Or if you haven't already had a meeting, definitely reach out and have a meeting with someone to see what you will be able to do over the next year or two.
Mm-hmm. What about key takeaways for investors?
I'll just go back to that one for 1 second. Those changes aren't coming into effect until the 1st of January 2026. So we've now got the next 6 months. So if you're in that situation where you're wondering, well, what is possible, actually have the conversation now.
Yeah.
So then you've got 6 months to prepare yourself. So come that 1st of January, you're right. You can go get your pre-approval and you can get going with it because you've got 6 months to prepare.
Mm-hmm.
Yeah.
That is good to know. Key takeaways for investors. Probably just the increase of supply.
Yeah, I don't think there's going to be too much change for investors right now.
Mm-hmm.
Probably in the short term, there might be like a little bit of property price growth just due to the more demand and more first-time buyers being able to enter the market.
Mm-hmm.
But as Janine said, that might only be on like the lower end of properties or like lower to mid end of properties.
I'd say for your investors, it's business as usual.
Yeah.
Not a lot has changed, so just keep doing what you're doing. If you're investing, just keep going with it.
Yeah.
Good to know. Okay, well, thank you for the recap of the Labor's government. Lots of exciting stuff, and I think our audience will really appreciate the insights.
Yeah. Thank you for that. Cheers.
This is Money Stories.
Brought to you by Amy and Ben from In Financial Services.